For a contractor, it's not enough to have the safest processes, or the most accurate estimating, or leading-edge technology and tools. For a builder, what's required is construction that's even more advanced in the form of experience and insight and leadership. At Leopardo, our people are among the best and the brightest in the industry, who build world-class projects across practically every major sector. At Leopardo, our people are the reason for our success.
Almost all of them have promised me that they are not going to say that 2014 is going to be the same as 2013, only a little bit different. Instead, we're going to be focusing on those things that we need to watch, that we need to understand, that could be some real risk, but also could be some real opportunity. We are not, none of us are wizards, and none of us are 100% right. Therefore, I'm not going to ask anyone to tell us what will happen. But I am asking what could happen and what are the disruptions on our horizon. We certainly live in a time of incredible disruption, and it's not over yet. We certainly had a very interesting 4 or 5 years. I'm sure the fact that all of you are here sometimes seems a bit miraculous after some of the things we faced in 2007, 2008, 2009. But, I think it's interesting to understand evolution. Probably one of the most misunderstood and misapplied theorists was Charles Darwin. This concept of survival of the fittest. Actually, he would talk a lot about not the strongest being the ones who survive, or the biggest, but the most flexible. Because as things change, there's no way of predicting how they're going to change. And those that are most supple, most flexible, are most likely to survive. I would submit that the people on this panel are among the more flexible people in our industry, and certainly in the city of Chicago. So we're going to run through, have everyone introduce themselves for a minute or so, and then we will come around to the questions. So Joe, want to take it away?
Yeah, hi, I'm Joe Cosenza. I'm one of the 4 founders of Inland and vice chairman, and Inland, from being 4 teachers to going into real estate, is now in 48 of our states with about 700 or 800 retail locations, about 70 office buildings, about 60 industrial, 17,000 hotel rooms, mostly Marriotts and Hyatts, and about 10,000 units of student housing and apartments. And one last thing, since the beginning of what I call the recession of 2009, we have purchased about a little over $9 billion of real estate.
Good morning, everyone. For those in the back, there are seats up in front, if that helps anyone out there. My name is Todd Mintz. I'm Executive Vice President and co-manager of our Chicago office for DTZ. For many of those that have been around for a while, Equus is our former company, and we've kind of been rolled up over years into what's now DTZ. Our firm is still considered still the largest, one of the largest firms in Chicago that just specializes in tenant representation, office and industrial tenant representation. And our size and scale today, under the DTZ umbrella, we're about 47,000 employees globally, 208 offices around the globe. We are considered a full-service real estate firm. We have about 12,000 people here in the States just focusing on facility maintenance, construction management, consulting, workplace, transactions, capital markets. And on size and scale, we did about 22,000 transactions globally last year, 2013. And we pay from a office lease administration type basis, for another way of comparison. We take care of about 25,000 rent bills on a monthly basis for corporate America. And that's a little bit about our firm.
Thanks, Todd. I'm Michael Flynn with NAI Hiffman, based out in Northbrook Terrace. I've been in the business about 30 years with NAI, as well as its predecessor firm. My focus for the past 27 years or so has been suburban office, so I'm thankful that the suburban office is not dead, as many people think. But hopefully can share some thoughts today in terms of what does 2014 bring? What are the challenges that we face? In contrast to some of the things Steve spoke about that's going on in the city today. Thank you.
Good morning. I'm Drew Neiman. I'm Executive Vice President with U.S. Equities. I've been in the capacity that I'm in, which is the landlord side, primarily downtown office leasing and marketing, for about 31 years. 28 of those was with John Buck, with a little stint in the Middle East doing CRE real estate. And then came back here, spent a couple years with Colliers, and most recently with Bob Wislow now at U.S. Equities this past year, which is a full-service real estate development, management, leasing, PM, consulting. Great company, and really working hard on not only existing assets, but new development as well, which I think we'll get to when we talk about the state of the market, at least from what 13 showed and what we got look forward to in 2014.
Hi, my name's Tim Hennelly. I'm president of the Great Lakes region for Ryan Companies. Ryan is a design builder and developer based in Minneapolis, although I've spent my whole career here in Chicago. I run the Great Lakes region, which is one of 6 regions across the country, and together we'll put in place about $1 billion worth of construction and development across the country, ranging from a 2 million square foot office build-to-suit in Phoenix down to a 20,000 square foot MOB in Milwaukee. Here in the Great Lakes region, we're focused on 3 things primarily: our multifamily business, which ranges from market rate to affordable senior to assisted living; our healthcare stuff, which is medical office buildings and some construction for hospitals; and then industrial, which is our industrial parks here. We're getting some pretty good traction on build-to-suits and spec buildings. That's where my background is. 30 years ago or so, I started as an industrial broker, so I'll try and shed some light on the industrial market.
Thanks, Tim. My name is Tony Smaniato. I'm an executive vice president at Colliers. I started in the office investment business the Monday after the Bears won the Super Bowl in January 26, 1986. It seems like a few minutes ago, but it's been some time. Primarily, my entire career has been spent in the sale of CBD and suburban office buildings in the Midwest. I currently am at Colliers. As you know, we're a very large global organization with over 480 offices, 13,000 employees. Been here in Chicago. We've got myself and my fledgling team serving the office market. We've got a group that does net lease and retail. We've got the Dissy Divine team garnering all the industrial market share in the area, and we continue to grow in this market. So I'm excited to be here. Thank you.
Excellent. Thanks, Tony. So just to lay some groundwork for the discussion, I'd like to start a little bit by kind of trying to understand a little bit of what just happened in 2013. And in particular, for all of our panelists, to kind of address what are the things that perhaps we think happened in 2013 that is counter to the conventional wisdom, and what are the things perhaps that we might have learned, if we've learned anything, from the last year. Joe, you want to take that one to start?
Yes, I'll take the area mostly of retail. We have experts here on the panel for office, and so I think I'll touch on retail after I gave the history of Inland. And if you don't mind, I'll stand up. I'm okay. I'm okay.
Like a Chevy Chase moment.
Now, many of you out there have been with friends, have been with business people, and darn it, you slipped, you fell, you bumped your head, you bumped into a wall, and the first thing, of course, is the ouch. And then the second one is, hey, I'm okay, I'm okay. And all you're doing is hiding the embarrassment underneath the I'm okay, I'm okay. So this little stunt here really kind of demonstrates what I believe the retail economy is like. Let me give you an example.
And the award for best metaphor goes to Joe.
So let me give you some examples real quick. The first thing is the ouch period. Well, the ouch period we all know was 2009 until about this last year. The ouch period. Then there's the I'm okay, which is the 2013 period. And then when you have the embarrassment, but I'll get to that in a minute. So let's take retail. First, ouch period. 200,000 small businesses went bankrupt, not to mention the hundreds of thousands that closed their doors. 2013, I don't have one single small guy going bankrupt. I don't have I don't have many small guys going out of business. Occupancy on anchor stores. We had 92% for the anchor stores back in the hurt period, back in the ouch period, and then now in 2013, we're up to a combination of past 96%, past 93%, past 97% in the different companies that have retail around the country. Renewals, 70% in the ouch period. Today, we're way almost 90% on renewals. 2013. That's the I'm okay period. Hey, so where's the embarrassment? I'll get to it. So, how about anchor tenants expanding, or what do they call it, backfilling? Back in the ouch period, 0. 2013, I'll give you some examples. Up in Lincoln Avenue, I got Lincoln Village. Do you remember the Borders that was there? It's vacant. Oh, by the way, that reminds me. How many people have a Kindle or a Kindle Fire or a Nook? How many got that? Just show of hands. Hey, thanks for closing up all my Borders. You know, with...
It's all your fault.
Yeah. You know, with graphics like that and my West Side Chicago language, I don't think they're going to give me a bit part on Downton Abbey. But, all right, so I'll give you an example. That Borders now is a Ross. And fortunately, got more rent. Same thing happened in Orland Park and in other parts of the city. That never happened back in the ouch period, but it did happen in 2013. How about small shops? Well, back in the ouch period, nobody was coming in. They were going out. In the I'm okay period, 2013, people are coming back. They're renting the small shops. How about the Five Guys? How about, they got a new place now called, what is it called? Eyebrow threading. Oh. All you have to do is seal up the walls. Holiday sales. Now, holiday sales means November 1 to December 24th. According to the ICSC, 2.3% increase. Hey, where's the embarrassment in all of this? Let me tell you where it is. Those holiday sales at 2.3% was the lowest gain since 2008. And you know how they got those holiday sales? They came into the store because there were the deepest discounts you have seen since 2008 in competitiveness. And you're seeing right now in some of the stores where they're reporting their revenues were down even though their sales were up. That's the embarrassment that's hidden behind the I'm okay. Okay, how about small shop tenants? Well, not one single one of those people that closed up their shops ever came back to us. How about store visits? The week of December 15th, store visits were down 20%. Where were these people? On the doggone computers buying online. Those sales are up 10.3%, $4 billion. Now think about that when you hit that key of the people that can't work in the stores anymore. Think about that when you're reading on your Kindle Fire. I know. The stores that had to close up because of that. And then one last thing. You have J.C. Penney closing up 33 stores. Dominic's just closed up 72 of them. Target's going to close up 8. You have Macy's closing up 5. Albertsons is closing up 26 stores around the country. This is the embarrassment part of the I'm okay. That's it for retail right now.
I'm exhausted. I think it bears noting, though. I mean, certainly retail is at the center of one of the largest disruptions in all of our lifetimes. Cast yourself back to the turn of the 19th century to the 20th century. I know there's a few of you here that might remember that personally. That how many people in 1920 were working in jobs that existed in 1890? Very, very small number, especially in blue-collar work. The world changed. It's happening now, and it's certainly happening in retail. It's also happening in industrial, which is changing more than we ever thought it would. And I asked Tim to kind of talk a little bit about it. It's been an odd place, hasn't it, industrial in Chicago? And
I'm not following Joe.
I just figured, and you don't have to fall. That's okay. That's okay. So if you could give us an idea of what's happened, because it's starting to make a real turn, don't you think?
It is, and the ouch period. I'll continue along Joe's metaphor there. We had an ouch period in the industrial segment, really in the 09, 10, like everything else, where it dried up around the country, and we lost our vacancy. Our net absorption was quite a bit negative here in town, and our vacancy rate in Chicago hit an all-time high of about 11%. That's 1 billion square feet of space we have here in Chicago. So we had 100 and something million square feet empty. Now, you fast forward to the I'm okay period, we're at about 8%, 8.4%, which is still 84 million square feet vacant. But I think the important part about that locally here is that a lot of that space is functionally obsolete. It's not, if you want a grade A 500,000 square foot building, we have a few down in Joliet, but there's not a lot of that space available. So what's happening to the functionally obsolete buildings are they're being repositioned. I mean, Elk Grove Village, where I grew up, along with Leo, I see him out there, they're doing a lot of teardowns of old buildings that are 24 feet tall and rebuilding them as 30 feet and make them fit better onto the site so we can maneuver trucks. There's a lot of that going on in Elk Grove. And all the ring between Franklin Park, Bedford Park, and into the city, that's happening. Nationally, we're seeing, we do a lot of work for Target Corporation, so we're still building the very large distribution centers for them, food distribution of 600,000-700,000 square feet, still the dry storage distribution of 1.5 million, but they're slowing down certainly. The one that's coming along, as it is in the retail on Target's heels, is Amazon. And Amazon comes into a market, like we sold some land to them in Tampa, to build 1 million square foot distribution center that is mezzanine up to about 3 million inside under the roof. And then they're going to put a fulfillment center right next to it for about 600,000 feet. So there are big, huge consolidations of some of these guys you used to spread them out into 4 or 5 or 6 different buildings, like Home Depot down in Romeoville, Bolingbrook area. Used to be in 6 buildings, and now they're in under 1 roof or 3 roofs down in Joliet of about 2 million feet. So overall, it's certainly we're out of the ouch period. We're into the I'm okay period, and even the embarrassment. Our rents are coming up here in Chicago, which was the difficult thing. We did a spec building down in Romeoville 3 years ago now, 2.5 years ago. That was the first one to come out of the ground with DCT Industrial. Those numbers were really hard to pencil out because the rents, the data points that they could look at were $2.75, but we knew that there was a bit of a lack of supply coming up. So we thought the rents, and they proved out to be true, hopefully, or thankfully, it's over $3. So we're seeing, the industrial market, I think, is very healthy here in Chicago. Around the country, it's healthy. Capital rates, cap rates on warehouses in Chicago are, depending on where you're at, I mean, there's Opus sold theirs for 5.4% cap rate, but it's a little nuanced. But, they're in 6% to 6.5%, which is very healthy. Around the country, even we sold a building outside of Des Moines that was a 7.2% cap. And that used to be a tertiary market, so it was a little higher. So I think we're out of the ouch, we're into the I'm okay, and it's actually out of the embarrassment where our rents are coming up.
Fantastic. Now, but you did mention to me on the phone yesterday that I found very interesting that the speed of obsolescence that is occurring, that it's accelerating with these buildings. I mean, could you give a little bit a note on what you saw this year in terms of how fast some of these things are out of date and no longer functional?
A good example of that would be Clear Heights. Like I said, in Elk Grove, there's a whole bunch of buildings that are 24-foot clear. For the last 10 or 15 years, we built buildings at 30-foot clear. And now 32 is the norm on spec buildings. And we're doing the Ashley Furniture deal down in Romeoville. Those are 40-foot clear buildings because of the racking system. So really what's happening is we're building buildings, we're building envelopes around very, very expensive racking systems and material handling systems. That's where it's going. And they found a way to use the cubic feet of a building that no one else ever figured out. When we still lease on a square foot basis, we should think about going to cubic foot.
So Amazon isn't just wiping out the bookseller, it's also wiping out thinking in terms of how industrial works and how these buildings work. It's fascinating to see how it's changing. But, of course, if you believe everything you read, the suburbs are dead. So there's no need for us to talk to Michael, or is there, about what happened in the last year in terms of suburban office?
The suburbs aren't dead. I mean, there's 100 million square feet of occupied suburban space. There are many firms that are moving into the city, but there are still firms that are moving back out from the city, and there are firms in the suburbs that are growing. But there is one thing that goes on in the suburbs that we have not quite figured out yet. Rising tides don't lift all boats in the suburbs. I think the same rent roll downtown, and I don't know this for a fact, but I believe it, the same rent roll downtown 2 years ago would sell for more today because of the opportunity that is perceived to be created downtown and the rising value of real estate in the city. You would not have the same thing in the suburbs. The rent roll from 2 years ago, the rent roll now, you may have a few more tire kickers, but it really would not increase the value very much. So rising tides are not lifting all boats. It's only those buildings that are better positioned and are differentiated from others that are capturing market share and are actually bringing our occupancy level to below 20%, or vacancy level to below 20% for the first time in 5 years. There are still many obsolete buildings, and there's not an opportunity with a redevelopment of those assets to the same extent there is downtown, because the cost of that redevelopment would not generate a suitable return for the risk involved. We see many buildings still that have turned at low prices that have not yet been able to make the reinvestment in a fashion that warrants, they're not able to make the reinvestment that would warrant new tenants coming into those buildings to bring that occupancy up. Nevertheless, those that have the appropriate amenities, the infrastructure and location, I think can be successful going forward.
And certainly it's going to be a different office user out there than what we saw in the past if the deputy mayor is to be believed that no one is going to locate their headquarters out in the suburbs anymore or relocate. So it's an interesting change that's occurring there. The city is different from the suburbs in terms of the office experience. We have two people representing both the tenant and the landlord, so please no fisticuffs. But if Drew and Todd, if you can give us a sense of what's going on in Chicago versus the suburbs.
Well, Todd's eyes perked up when he thought of cubic feet. A cubic foot commission would be pretty big.
The commission would be exponential.
Exactly. We'd have to raise rents. I think the first good news is our first speaker today. When you have a deputy mayor and a mayor, I think of a quality and a sophistication as government officials right now. One of them's working for $1 a year. We're pretty fortunate here. And I feel, because I work on the landlord side, so I'm always trying to lure tenants, seduce them, whatever the word is, sell them, bring them into our buildings, fill them. You're also selling Chicago. You're selling the submarket. You're selling all the other things that go with it. And I believe, for the first time, that deputy mayor and the mayor, if you will, got our back. I mean, they're there to help you sell this in a way that I've never seen in a concerted effort. And I know they came to one of our real estate functions once about a year and a half ago and said, if you ever want us to come to a pitch, we're in. Now, I don't know what cut they're going to get out of the commission, but we'll figure that out later. But those guys, I mean, that is absolutely, you got to start with that. That's a great comfort just for openers. 2013 is, I'm okay. I mean, I think we finally stabilized, and we got modest growth. We've got reduction in vacancy. We've got reduction in contiguous blocks of space, which is a big indicator that we all look at least on the landlord side and the tenant side, because they want to see what their options are. But we've had suburban migration. So the big story was Motorola, under the veil of Google, but it was Motorola, Sara Lee, Kraft, GoGo. Lots of good, good action coming from the suburbs coming into downtown. Again, with Mayor Emanuel, right behind that. Second is what we call the densification of office space. This is a term that we're all dealing with today, and that's just fitting more people into less space. It's been a trend since we went to the open office plan 5, 6, 7 years ago, but it's picking up steam. The lawyers are doing it. I know that. I've done a lot of big test fit layouts for new buildings, and it's amazing how they're fitting into to less space with the same amount of people. But this also puts a strain on existing assets. Because if you think about it, more people in the same amount of space, you still got to cool it, you got to heat it, the elevator's got to work and get people up, especially at lunchtime, which is the two-way traffic, which is always challenging. So the infrastructure of these existing buildings starts to be challenged, and in some cases, they kind of opt out and become alternate uses, which we saw. There's 4 or 5 of those options are going on right now in the CBD, where they're becoming hotels. They're no longer going to be office buildings. So those are trends that are going on. Real quick little analogy, one of the buildings we manage and lease at U.S. Equities is Willis Tower. Just an interesting note, over in 2013, they looked back at when they give out badges for employees, new employees for the year, and they can do a count for every tenant in the building and add it together. And it was just a little thing, but it was about 350 net new employees in the building across all the different, companies in there. That's that kind of the start of I'm okay and we're kind of getting a little better. That's not huge, but it's a good sign that just quiet, and they're still hanging out in the same amount of space, but there's that kind of underlying feeling like we're starting to add. Things are becoming additive. And then last, I think, is a great announcement in 13 was 2 buildings, Hines at 444 West Lake and O'Donnell Investments, who I represent on the leasing side, at 150 North Riverside, both announcing new construction underway, which would break ground this year in 14 and deliver about third quarter of 16. It's about 2.2 million square feet total. It's not a big deal if you think of about 140 million square foot base that the city has. It's barely 2%, but it's a good sign. The buildings that have been built, think about this, since 2000 is 15.8 million square feet of new office buildings have been built. The average vacancy rate of those buildings is 4%. And the market's hanging right at around direct vacancy, 12.5%. So there's clearly a demand for new product. And also when you get to this densification, a new floor plate, new systems, those are things that can really be handled going forward if you plan for them versus a retrofit. So I think those are, all good things. The last is the development cycle was 01 buildings were delivered, 05, 09, then the market crashed. And so this next delivery will be 06, which is almost double what the other ones were in terms of time frame. So again, I think the market usually corrects itself and almost monitors itself as to how you deliver this and when they're ready. So.
Well put. It's interesting. My members who are institutional investors in large portfolios of commercial real estate across the country, everyone knows now, everyone in this room I'm sure knows that every law firm, when they sign up for a new lease, it's about 30% lease on a per lawyer, less on a per lawyer basis. What we're starting to hear from a lot of people is not just that they move into something that's 30% less, but then they say, you know what, we could reduce it another 30%. So I think, we're still not at the end of that trend. I think there's more pressure that's going to be applied. And again, if lawyers are doing it, I mean, they're the least likely to do something like that. So it's something to keep an eye on. I think the notification is something that will continue to be a headline probably in 2014 and beyond. So if you could give us a perspective from the landlord side, or from the tenant side. I'm sorry.
From the tenant side. Well, I agree with what you just said, Gunnar, that if all we're doing is working with the tenant and the user of the space, that's typically what we hear, is regardless if it's a local business or it's a big corporate U.S. or global, they definitely want to focus on how they're using their space. There's going to be some type of efficiency factor. They want to be more conscious in regards to environmental factors. They're also going to be more conscious of kind of what that worker is today versus what it was 10 years ago and what it might be 10, 15 years from now that we're building out space for today. You know, the worker today, if we're building out space, it's going to be delivered 5, 10 years from now. We're thinking about these buildings. This worker grew up with Facebook as their form of communication, is advanced in technology, and is used to kind of working in a totally different environment. And that's going to be a big impact to our employers today and how they're going to be looking at office space. And as a result of it, they've been a lot more cautious in regards to what they're out there looking at, how they're laying out their space, to Drew's comments in regards to, you know, how the buildings are laid out and so forth. I think that's a big factor today. I would kind of stand up the way Joe did it. He did a great job with it. And I've seen Joe speak before, and it's always great to kind of hear, but I would kind of echo a lot of what Joe said in regards to kind of how occupants will be thinking about office space going into the future. You know, it was those businesses were all hurt, 2008, 2009, 2010. A lot of them have survived and have rebuilt and reformed themselves and are much more cautious and much more thoughtful in regards to the way they acquire office space, and in the way they're going to be thinking about office space. I think in the future is going to even be more impactful to the kind of way we're looking at some stats. So I put together a couple of numbers, which is great for Chicago. Unemployment rate. So from an unemployment rate, the way we track it, about a third of the unemployment rate is white-collar office space type users, about a third roughly. So from 2010, fourth quarter, overall Chicago unemployment rate was 9.1%. U.S. was 9.4%. Chicago did pretty well. We continue to kind of decrease our unemployment rate, as everyone knows, but as we ended the year 2013, unemployment rate was 8.1%. U.S. average was 6.7%. I think that's going to have an impact on kind of how we're looking at office space in the future here in Chicago. One other thing that we've been kind of watching very carefully is asking rents and vacancy. So one stat I thought was kind of interesting. First quarter 2010 or fourth quarter 2009, right after the kind of big crash, average asking rental rate, CBD, was first quarter, the way we tracked it, was $30.03, with a vacancy of 16.5%. And our stats show that at the end of fourth quarter 2013, asking rental rates were $30.02. Overall vacancy down to 13.2%, which is good for some of the developers and so forth too. There's going to be new buildings built. They have to be built because there's a demand of the way these companies are designing and desire their space, bigger floor plates, more efficient, better cooling, access, different amenities and so forth. But I don't know if it's going to be like the cycles we grew up with, because it was predictable that every 5 to 7 years there was a new wave of office development. And for the guys that I've been up here with for 25 plus years, we've seen that. You know, what's going to happen though is the way we're counting it, we have a few new buildings coming online. We have quite a bit of vacancy in Chicago, downtown vacancy and suburban vacancy, that B space with limited demand. And then if you start to count up, what we did is all the financial service firms from first quarter 2013, actually fourth quarter 2012 to end of 2016, we predict the financial services firms and a few of the law firms will be putting a little over 2 million square feet back on the market in downtown Chicago. So that is going to have another kind of impact in regards to kind of just vacancy. So to Joe's kind of point earlier, a little bit of embarrassment, everything's okay, but I'd still kind of be real concerned kind of going forward. I think that, for us, that in the office world, it's gonna stay. We need to be cautious going forward with everything we're doing with that particular market.
Well, certainly fundamentals are interesting. Tony, love to get a sense in terms of trades and sales and capital. How is that playing out at this point?
Sure. From the surface, the investment market looks like it's going great, and I can verify that because very few of my competitors are in the room today. They're out chasing deals. But the market overall has still been strong, and the observations that I make and what I hear most from investors is they struggle with, more in their research department, their underwriting department, they always struggle with Chicago lags the nation in new jobs. We've got a disparity in the unemployment rate. We've got an ample labor pool. We've got the worst pension crises across America. Chicago's worse than Illinois, according to Marquette University. We've also read that there isn't a value proposition for office in Chicago. Yet, the city that works keeps working away and still is a global target city for investors around the world. I think that has a lot to do with a couple factors. The underwriters that are concerned about all these bad news economic statistics are very soothed by the tremendous burst of urban residential population over the past 20 years. The fact that the young new talent pools want to live downtown, and those employers who occupy office space want to hire those young, smart people. We've also got a mayor that makes big project, big headline announcements. I think that gives a lot of comfort to the marketplace. And we also are in a time of very plentiful debt and equity, which, as most of us know, is usually the driver of the investment bus. So Chicago continues to be a great target. I think downtown last year we did almost $3.7 billion in sales compared to the prior years of 2 and 2.8. In the suburbs last year, depending on how you count it, whether you include medical or smaller buildings, over $1 billion in sales compared to prior years of 730 and 900 million. So we're seeing big volume, big trades. Last year downtown, the bulk of interests came from investors in big deals that wanted core or core plus assets. But we've noticed over the last, 18, 24 months, a lot of investors that are more willing to take risk and seeking higher yield have moved into the marketplace. So that's always a sign for us in the recoveries when we start to see the value investors and opportunists moving in. And in the last 3 recoveries I've unfortunately had to live through, what I always see is that Willis Tower area seems to revive first in the downtown, and then everything grows away from there. Generally, in the suburbs, what we've seen is the investor really seeks to be, just like the trend in the general leasing market, wants to be in the A-quality buildings because the tenants are fleeing to the A-quality buildings. They want to be at Main and Main. They want accessibility. They want to be on transportation networks if possible. Or they want to be in the single-story commodity, i.e. cheap space. So we've got kind of a bifurcation in the market of investors wanting to see both. I think somebody earlier mentioned, can we track assets that have sold twice, in a cycle? I mean, Central Park of Lisle is a good example. I mean, in the suburbs, I think you mentioned, Michael, was kind of a flat, sale over sale. But Central Park's a good example. I think that traded for $88 million or so when White Oak bought it, and recently sold for $116 million. So there definitely was some profit taking in the best located, arguably the best located, best asset in the suburbs. Others not faring so well. we had some pleasing results downtown in that we've seen buyers continue to invest in the market and put a lot of eggs in that basket. KBS, a good example, coming in and buying 500 West Madison after the 300 North LaSalle purchase a couple years ago. Beacon, after a small vanishing act, has come back and has begun acquiring assets. We've seen a steady now invasion by our Canadian friends into this market, as well as across the United States. But Ivanhoe Cambridge, working with Callahan, bought the Riverside properties. They've invested heavily in the plans that Heinz has at Wolf Point. And we've also seen Manulife, who in the U.S., works as John Hancock, purchase a couple more assets. So it's great to see the Canadian firms coming in. And there's Korean activity, Korean Pension, Korean Post. They've invested in the Chicago CBD. We're starting to see a lot of Chinese investors get organized and come back to the U.S., so that's reassuring. And again, the debt market, I can get into detail later if you want, but
It's healthy.
There's money, a lot of money available. If you passed up on the chance to invest directly in real estate in the last recovery, don't do it again, because there's no reason to. The recourse money is back. There are blue light specials going on in the first quarter, non-recourse deals. A lot of the banks and life companies are giving great deals in the first quarter, trying to put money out on the street and invest it into real estate. So I think it's a really exciting time. And even in light of Chicago's woes that we read about nationally, I think this is still a major, major marketplace for international investors.
And just to add on to that and to transition into talking a little bit about the future and what we're looking for, as we've surveyed our members and talked with pension funds, endowments, both foreign and domestic, about investing, 2012, they were all raising money. About 60 to 70% of the money that was being raised at that time was for core assets in about 6 core markets, period. Value add was invisible in terms of the fundraising activity. In 2013, it flipped. 60, 70% of the fundraising for new acquisitions or acquisitions of existing product was value add versus core. So to a certain extent, the pension funds have gotten to the point that they can't make money off of, sub-4 cap rates in Manhattan. They're starting to look elsewhere and to see where value can be added, and they are taking a lower yield or a lower expectation of yield out of that. So what this could suggest, barring all sorts of strange things happening as they always do, is that more money is going into value add, more money is going into markets that may not be the prime of the prime, including, to a certain extent, Chicago.
I can tack on to that a little bit. Another observation we made is that, and for several years now, is that another reason Chicago investment activity continues to be strong or show large numbers relative to other cities during these recessions is that a lot of big members of your organization have really begun to embrace venturing with local partners in the marketplace. So we've seen a lot more of institutions that Colliers even has been referring into me that want us to really, number one, identify a strong local operating partner, and I see a couple over there, that they'd like to connect with because they bring the market intel, the market knowledge, and that's how you really set yourself apart in Chicago.
Absolutely.
Versus a commodity, not a commodity investment market, but a market like Washington or Manhattan where cap rates are cap rates and buildings
to
are
a certain
buildings.
extent, for local operators, FERPTA can be your friend for these investors that are coming in from Canada and Korea right now seem to be 2 of the biggest areas because they have to have you by law if they don't want to give away all their yields and taxes.
Yep.
So Manulife, Morguard, GWL is coming into the U.S. after only being domestic in Canada for a long time. Bentall Kennedy is so aggressive they bought a company in the United States. I think get to know your Canadians, get some bacon and some donuts, and spend time with them. It's a good idea. Not only that, I think any of you that speak Korean, spend some time over there. It's a good time for that, and a lot of money is flowing in that way. So let's switch just a little bit with the remaining time that we have. And really what I'd like to do is get all of you to kind of talk less in terms of what you think will happen, but more in terms of what do you think might surprise us to the up or to the down. Who wants to grab that one first? Joe, you eager to grab the mic on that? Or?
Oh.
You don't have to fall.
What could surprise us? Well, yeah, I think it's pretty damn obvious. If you... Again, they're not going to put me on Downton Abbey. the more you click on that computer screen to buy something, the more you're going to have stores available for occupancy. And boy, I know it's like a drug. It's in your arm, and you hate to take the needle out. But one of the things you can do is, and I did this, honest to God. One, I like to shop at things we own, only because they pay us rent. Well, so I'll give you an example. Walmart out in the suburbs, okay? I go online, I buy must have been 26 toys, but I bought it through the Walmart site, and I picked it up at that Walmart store. So that Walmart store got all the credit for the sales, and those people who are working there are still working there. That's possibility of one thing. I don't think that answers your question. Any other surprises? I don't know.
He knows, he's just not telling. Any other thoughts in terms of...
Along those lines, Target is looking at their stores and trying to figure out a way to compete with Amazon, who has come up with this same day. They want to, people click on something and they want it home by that night. So Target is looking into their stores and trying to figure out how to reposition them and renovate them to be kind of a half distribution center to do exactly what Joe just said. Maybe there'll be some vans taking and delivering around town, but it'll just be able to stop at your local Target and pick it up.
I would actually add to your comments here a recommendation that everyone, not just those of you that are suffering with Joe in retail, everyone needs to pay very close attention to what's going on in Amazon, and not because they're playing with drones. Nice little PR stunt there. But because they're affecting almost every asset type in real estate, and wherever Amazon goes, bodies follow. It's not just industrial in terms of changing what an industrial plant is, but it's also multifamily in terms of turning them into package depots. It's changing office. It's changing everything. And the more Amazon gets into our space in real estate, the more interesting it will become. But be careful. They are after your asset too, even if you're not in retail. Would you say that's fair? Then we have to be careful.
Was anyone here did anyone attend the NIOP forecast last week in Rosemont? A few people. I recalled seeing Dr. Mark Epley from Marquette present a different and more soothing chart for you, Joe. And I know people can't see this, but he showed the explosive growth of Amazon. You can see this curve. It's just going straight up. And then he listed everybody else, Best Buy, Walmart, Apple, Liberty, Sears, Dell, and their percent of their total revenue that they do in internet sales is an absolute flat line across the bottom. And his point was that, and he was discussing retail having a great value proposition for Chicago, unlike office. His argument was that the brick and mortar isn't going anywhere. So I don't know if that's any more soothing to you or not.
Well, I saw that, and I'm not sold yet. I want to be sold, but I'm not sold yet.
Okay.
I mean, I think another part of retail that's interesting is if you look at density of sales, this has been well publicized for a long time and maybe less true now. But when you look at the average retail sales of a shopping mall, a high street retail, there is no comparison between that and what Apple sells out of their stores. So, I think Tiffany's does about $3,000 a year per square foot. Apple does $6,000. And not because they sell more stuff, but because they sell less physical stuff.
Right.
They've created a high density proposition. And it's interesting to me, if you watch a lot of other retailers that are trying to figure out how to mess with this, they're figuring out how to increase not just the density of people, but the density of sales per square foot. Look at Walgreens. I predict they're going to be in the lunch counter business before you know it. They're looking at how they can sell other things besides shampoo in their stores. And whether it's retail or it's office or it's industrial or even multifamily, density is ruling at the moment in terms of ruling what we're doing.
I certainly think for office, as I mentioned earlier, it's going to be density, different efficiencies, different layout is going to be a big thing in the future. That's what we're going to see. We're going to continue to see that. And I also for Chicago and what we see and what our clients are telling us, all they want to do is focus on opportunities on how to get office space and locations downtown versus suburban or outlying locations. They'll consolidate. They'll move people downtown because not just in Chicago, but elsewhere around the country, all the major CBDs, there's a densification, there's a draw to being in the city. It's where they're going to get their talent. It's where they're going to get the resources. And it's no different here in Chicago, too. And I think that just plays out to kind of what we're going to continue to see here in Chicago and in the suburban area.
Quick question, Todd. Do you see there's a point of saturation that all of a sudden it's too dense? That the benching person to the right and left of you didn't bathe that day, and and you wish they had.
Yeah,
but
so
I mean, does it get to 130 square feet?
I don't know, and I do agree. There's going to come a point in time we're going to kind of go through this cycle of kind of how dense are we going to be? Are we all going to be working off of a kind of a iPad or something like that? I don't know where that's going to go, but I do believe there's definitely a huge push globally, domestically, by all these companies to get their people into kind of major CBD markets.
A new building in Boston, I think you probably saw in the paper somewhere, is being built, and it's for 9 people per 1,000 square feet. So that's a little over 100 square feet per person.
Right.
And you're right, you need more elevators, more toilets. What about parking?
One thing, though, to be careful, especially in white-collar financial, real estate, investing, consulting businesses, several studies have shown that the amount of time that people sit at their desk on a 9 to 5, 40-hour week, where do you think the number would be on average?
What was that question?
How much time do people spend at their desk?
62%.
I've seen numbers ranging from 30 to 60% of their time. So part of the reality is the nature of work is changing. Admittedly, in call centers, we're all working in a factory and we're all very close to each other. But the reality of the way all of you work is that you're not actually in that desk all the time. So some of that is shifting as well, and that's part of what's allowing this to happen. Otherwise, I think you're right. The body odor issue would be probably even more prevalent than it is now. Yes?
Maybe this is a fault of my attendance at many Cornet, ULI, and NIOP functions, but I other than the debt and equity markets, going badly overnight, I think on a long-term basis for office space, at least what we hear, at the higher level in these seminars and breakouts, is people are talking about what I call the 3 Bs, which is, I refer to it as bridges, bandwidth, and build-out. And what I'm seeing in the office arena, first of all, bridges really encompass, what I'm trying to say is infrastructure. And, there's a lot of things in the city that are old, and besides highways, and I don't know, those of you who ride the Metro, the rolling stock's brutal. CTA, there's a lot of infrastructure issues that, I'm sure the mayor and deputy mayor are looking at, but I'm not reading about it. So that could be something that could hurt Chicago in the long term. Bandwidth is another one, and I think Drew mentioned it yesterday. If those of you who've been to Wrigley Field on a Friday afternoon or River North on a Friday night, you're so spoiled you can't pull up a website or Grubhub on your iPad. Our building's going to be able to adapt to the technology, and is the infrastructure going to also help them do that? And lastly, on build-out, you brought up alternative workspace, and I'm at the Cornet organization at the board level, so I see a lot of white paper, and it's just amazing how companies are getting into the special purpose branding their product within their space, and needing extra inches or feet or density or elevators. And I don't know if the bulk of our, some 260 million square feet in this market is going to be able to accommodate that, if the Motorola Mobilities and the Go-Go's and Coca-Cola and
So there's
Pepsi.
going to be some infrastructure changes, but one thing that we really see going into 2014-15 is we'll see a lot of renovation of buildings downtown. You see what Sterling did on West Fulton. You see what's going on with Wrigley Building. Folks that do office leasing downtown, Jordan Sloan and Harbor Group, they're purchasing One South Wacker. They're going to be kind of renovating or remodeling a big chunk of that for today. I think you see a lot more renovation going forward. There's a few buildings, Prudential Plaza, 231 South LaSalle. There's a few of them that are going to go through that whole process. Citadel eventually, too, on Dearborn. And I think that'll help.
Dogs?
There are a few dogs. Those will become
No,
hotels.
I mean real dogs. I mean, I'm getting proposals now that are asking that dogs can be
Yeah.
brought to the workplace.
It's true.
So I have to amortize the poopy bags into this. But I'm serious. And Google's leading the charge.
Right.
You know,
Right.
it's pretty wild.
Right.
Right?
Dog run. Other markets, office buildings are being developed with dog runs, where you could they're rooftops, so you could bring your dog to work. You know, right now in Chicago we have bike lockers, and we can have showers and gyms and so forth. Yeah, other markets we're seeing dog runs and dog kind of like daycare in the office buildings.
What do you think, Joe?
Well, the offices
You're going to embrace
the offices
technology.
are a lot like apartments. You know, you get a B and C apartment complex, you may be pretty well occupied, but eventually you're going to have to upgrade. Well, you cannot push that ceiling past the 8 feet that it's at. There's no way you're going to change that. And so those new buildings, those new office buildings with the higher ceilings and the better feel, et cetera, is going to grab the occupant. It's going to grab the tenant faster because the tenant is going to use less space and doesn't mind paying the rent that he thought he used to pay for the larger space. But now he's got all new. Now, at retail, however, at least you see my vacancies on the street when you're driving around. You can't see these guys' vacancies.
We shut the blinds.
Well, you know, there was an interesting thing that happened during this period of recession in San Francisco was that they ran out of Embarcadero. They ran out of that cool 19th century industrial office space. So what did they do? They went into the CBD and they started tearing out the drop ceilings. And turning, 60s, 70s office buildings into stuff that was cool enough for these tech workers. Maybe they put dog runs in, I'm not exactly sure. But I think that's part of what we are going to continue to see. I mean, yeah, you only have 8 foot with a drop ceiling, but you can get another foot or two if you don't mind looking at the mechanicals. And people are adapting. They're figuring out ways to do it. So if you own a dog of an asset, it is possible to get dogs into the asset. You just have to be a little bit more creative. Any other things that you're worried about or that you're excited about in the upcoming year? Very briefly.
I'll speak about the suburban market one more time. We've been getting bashed a little bit here. Truly, the opportunity in the suburban market and what we saw over the last 3-4 years is the O'Hare market came back first. It had good transportation. It had the appearance for those outside the city of Chicago that you could continue to have a Chicago address. You're near O'Hare Airport. There's all the right reasons to be there. We're finding, too, that if you have buildings, whether they're in Schaumburg, whether they're in Northbrook or Oakbrook, if you can accommodate transportation issues first and foremost because of the density issues, whether that be accessibility via not necessarily public transportation, but immediate transportation to interstates, as well as with enough of a parking lot or additional parking to accommodate the tenants, you will be able to secure those tenants, be they catamaran or be they zebra and so forth, that are still looking at space in the suburban marketplace. The key to the suburban marketplace, I think, as an owner, is you need to know what your competitive set is, and you need to stay one step ahead of that competitive set. And if you can do that, you will continue to outpace the market. But if you're sitting and waiting for the market to come back to you with all the challenges that face a second-generation, third-generation asset, they're not coming back.
No.
And that is one thing that you'll see in the suburbs, that you will find those buildings continually sit for long periods of time.
One thing I love to do when national and international investors talk about Chicago and they diss us and they say, things like, you've been flat to shrinking in population over the last 20 years, is I point to the last census. And in the last census, even though we lagged much of the country in terms of growth, in fact, I think we shrunk a little bit the entire Chicago area. In the downtown area, within about 5 miles of City Hall, we were the fastest growing city in the entire country at 26% growth.
Great.
Sorry. No, I mean,
Great.
it's really powerful. And this density issue, diversity of use, how we are defining work, play, live, it's changing on us. And it's being changed by the changes in demographics, changes in technology. What our city will look like 10 years from now will not be recognizable to all of us that were working in 1995. It just will be completely different. We can't predict. No one at this table, even though I think we've got a great brain trust here, can predict exactly what it's going to look like. But I think if there's one thing to pull away from this is you're thinking about the changes that are being thrust upon us by society, that the real estate industry is changing, that flexibility needs to be the thing that you are constantly focused on morning, noon, night, and then long after you go to sleep. How can you be flexible? How can your buildings be flexible? How can your contracts be flexible? How can your relationships be flexible? How can you meet the challenges and the disruptions that are facing all of us, not just in the next 12 to 18 months, but over the next 5 to 10 years? And if so, and if you're careful, and if you're a little bit lucky, and if you have a sense of humor like Joe, I have a feeling you're going to be very successful. So on that note, I would like to thank all our panelists for sharing their thoughts.